and speaker for the evening, Spandan Shah. A very warm welcome and a very good evening to all the participants who have joined for the today's session. Globally, there are lots of challenges faced by the boards and management teams to have a closer relook at the purpose of the organization and its roles and responsibilities towards the society as a whole. The scrutiny by all the stakeholders has become sharper since the time pandemic COVID-19 has hit the world. There is a survey abroad which has found that 70% of the employees are now demanding purposeful work. They prefer companies that take a strong position on social issues. Customers are also carrying out business with companies which follows practices for sustainability. Even the Gen Z and millennials prefer to be associated with corporates having sustainable business. It seems Milton Friedman's concept of capitalism that the management has to look after the interest of one stakeholder, that is the shareholder, is being given a passe. The new concept of capitalism is a balanced capitalism, where interest of multiple stakeholders should be served to achieve desired outcome by the corporates. This balance, as per the belief and discussion at all worldwide forums, be it political, business, academic, or social, can be achieved by adopting the ESG roadmap for sustainable future of the planet. The mood and alacrity of the decision makers all around the world is to catch up with the years of inactivity around sustainability by vigorously ensuring compliances on ESG parameters. Oxford University had carried out a study of New York Stock Exchange and Nasdaq listed companies having strong ESG records at the start of the pandemic when markets started to collapse, and from 23rd March 2020 when markets began to recover. In both those periods, companies with better ESG records outperformed companies with low records on ESG. It is very aptly stated by Mr. Rupert Younger, founder of the Center for Corporate Reputation at Oxford University. Purpose does not come at the expense of profitability, but in many cases drives out performance. It is in this backdrop and criticality of ESG that BCS thought to commence its journey of imparting ESG learnings to its members and public at large through this lecture meeting to be addressed by a young professional who has passionately taken on sustainability as a professional pursuit. BCS is also determined to exploit ESG offerings in depth down the years to its members, thereby providing them insights on the opportunities which are unfolding for the professionals in area which is yet in its nascence. Before I request Meherbhai to introduce CS Spandan Shah, I take this opportunity to briefly interact with participants attending today who are not part of BCS family. I would like to provide glimpses of the activities that BCS undertakes for the professionals and public at large. BCS is the oldest voluntary body of chartered accountants and is in its 73rd year of existence. Prime motto of BCS is to disseminate knowledge to members, build their skill sets, and to provide a networking platform to like-minded professionals. It also acts as a catalyst by representing to the government bodies for bringing out better and effective government policies. One of the example was the representation which we made recently for the extension of time, and which has been considered by the government and bowed to the pressure of various professional bodies like ours. I request non-member CA professionals to join BCS as members, thereby gaining edge to excel as professionals. This can be achieved by gaining in-depth knowledge through workshops, seminars, and residential courses which are organized throughout the year by BCS. You will also be privy to the much appreciated BCA journal, A Gateway to Insights on Topics of Professional Interest. You will also be inclined to give back to the society through your sharing of knowledge. I now request Meherbhai to introduce the speaker. Thanks, and I hope you all will leave this meeting with enthusiasm for learning more about the ESG concept. Thank you.
Thank you, Abhay. Spandan Shah is a chartered accountant by background, and he's an ESG and a value chain management professional with 10 years of international experience having worked with Ernst& Young and KPMG in the UK, India, and Ireland. Spandan has worked with leading Indian and global multinationals, helping them design and implement tax-efficient value chain models, particularly during strange strategic events like M&A deals, international expansions, and business restructurings. He has recently completed his MBA from Imperial College London, as they say, class of 21, where he specialized in strategy, climate change, and sustainability. His focus areas include circular economy, sustainable business transformations, and ESG reportings. Spandan is also the founder of Green Analytics, a UK-based technology startup aimed at supporting organizations manage their end-to-end ESG requirements. Outside of work, Spandan is a volunteer with an Ahmedabad-based NGO providing education to less privileged kids, and is also a trustee of AIESEC UK, which is a charity organization. Spandan is going to cover and give us an orientation of background of the ESG right from there to what is happening globally and in India with the business cases for Indian companies and introduction to global ESG reporting frameworks and standards, discussions on SEBI, BRSR, as also an audit perspective. And finally, concluding his talk with ESG, what next? Thank you so much, Spandan. And we'll all our ears now to hear you. Over to you. Thank you.
Thank you so much. Firstly, Abhay sir and Mihir sir and the BCAS committee for inviting me to be a part of this event and for this opportunity to share my views and perspectives on ESG, a very growing, but more importantly, from my perspective, a very important and relevant topic for us as societies and businesses. Firstly, I am aware, thank you. Good evening, everyone, and thank you for taking the time to join this session today evening. I am aware of the rising cases of COVID back in India, so I just hope you and your families are well and keeping safe. Just bear with me for a minute while I share my screen and the presentation, and we'll kickstart from there. Hi, can everyone see the screen now?
Yes.
Okay,
Yes.
perfect. So as Abhay sir kind of briefly touched upon, we'll be looking at the ESG in terms of the global context and some of the changes that we've seen in the business landscape, which are expedited by the COVID pandemic. As Mihir sir also mentioned, here's a quick agenda for today. We'll look at the background and introduction to ESG, some of the news globally and in India, consider the business case for Indian companies, looking at the reporting frameworks and landscape, and what this means for us as the accounting profession, concluding with what lies ahead and what's next. But before we start, the focus of the session is on ESG reporting. But let's just pause and kind of consider why are we looking at this in the first instance. Why is ESG a three-letter acronym becoming kind of a top agenda item for most corporates in India as well as globally? So as most of us are aware, we are facing some global challenges from environmental aspects like climate change, biodiversity loss, as well as social aspects like rising inequality. We saw Black Lives Matter protest in the US kickstart quite a lot of discussions at boardroom level around diversity and the representation of minority communities in the business sector. 2021 also kind of saw climate events like wildfires in the western coast of the US, Turkey, Spain, Greece, as well as droughts and floods. globally and in India kind of dominate the newspaper headlines, right? 2021 was one of the 7 hottest years on record since data gathering began. For the past 2 years, social and climate risks have topped the global 10 risks by likelihood as well as by impact in the World Economic Forum reports. All this means that it is imperative for us as societies and business to work towards addressing this, not just for the future generations, but for us right now. A case in point is the recent rainfall that we had a week ago across different cities in India. It makes for a great Instagram story, but the impact on the agricultural community and the businesses that rely on agricultural output as their raw materials is not as joyous as you'd consider. So such global risks and challenges have led to a shift in the mindset regarding the purpose of a business from a traditional focus on just shareholder and profits, as Abhay sir discussed earlier as part of the introduction. The focus has now moved towards the wider impact a business and its operations will have on environment, on societies, on communities and other stakeholders which it impacts. Business Roundtable as well in 2019 essentially redefined the purpose of a corporate, moving away from shareholder capitalism to stakeholder capitalism. Milton Friedman, it would have been interesting to understand his views on the shifting business landscape. So that's from a global perspective, but similar challenges remain for India as well. It is one of the top 10 countries which will be impacted by climate change. Here is a snapshot of a vulnerability index of 29 Indian states, which is captured from a April 2021 report. 14 different socio-economic factors and indicators were considered while coming up with this ranking. It included socio-economic features, biophysical aspects, as well as institution and infrastructure parameters. The research also considered sensitivity and adaptive capacity of each state across those 14 different parameters. As you can see, states in the eastern part of the country are at most risk in most of the instances and across most of the parameters. But the message is very clear. Wherever your state ranks, environmental and social risks will impact us in some form, and that implementation of both adaptive as well as mitigation measures is the need of the hour. So, what exactly do we mean when we say, are you ESG compliant? Are you focusing on ESG? What exactly is this 3-letter acronym that we now hear pretty much day in, day out? So the environmental side considers how a company performs as a steward, as a guardian of nature. It could include topics like, net zero, so reducing your carbon emissions, looking at biodiversity, looking at reducing your waste and water consumption, and so on. From a social perspective, it would examine how a company would manage its employees, suppliers, customers, and communities in which it operates. It could, there's instances of Black Lives Matter. This is one thing, but we've also seen, big organizations like Amazon trying to stop its employees from forming a union. It's a debate whether that's the right approach or not, if you overlay the ESG lens. From a governance side, it deals with how a company is governed, more importantly, from an accountability, a transparency, and an ethics perspective. Some snippets of how chief executives have had to resign after lapses in governments. But there's also instances of senior people leaving organizations like Facebook and Google on ethical grounds as well. Looking at some of the recent global updates, particularly from an environmental perspective, obviously COP26 Summit, which happened in November last year, has dominated the headlines. There's significant progress has been made on the climate agenda, and the summit has also brought it at the forefront. Governments and local bodies have made significant progress and pledges in the key areas impacting the environment, which include deforestation. So there's a global pledge to end deforestation by 2030. There's pledges which have been made around methane reduction. So outside of carbon dioxide, methane is one of the most potent greenhouse gas which is contributing to climate change and global warming. There have been pledges around climate finance, trying to mobilize almost $1 trillion worth of capital to be then used on the technologies and on initiatives to reach climate goals. And lastly, on the net zero pledges, right? A few countries, including in India, made their pledge to be net zero by 2050, 2070, 2060, and so on. In terms of India as a country has also seen kind of significant developments happening on the ESG front. We look at each of these in more detail now. The first and the obvious one from us as the accounting profession is the mandatory ESG disclosure that SEBI has prescribed in terms of business responsibility and sustainability report. So from the next financial year, top 1,000 Indian companies by market cap will be mandated to disclose their ESG data. This represents almost a 10x increase in the number of companies having to report ESG data on a mandatory basis since 2012 when the legislation was first introduced. Some recent newspaper articles around that, but the scope of ESG disclosure is only going to increase, either mandatory, directly in a mandatory kind of perspective, or indirectly. So there's another legislation that SEBI is looking at governing ESG focused mutual funds. And what the legislation proposes is that from 2023, if ESG mutual funds can only invest in companies which have disclosed ESG data. So on one hand, there is a direct mandatory reporting requirement on top 1,000 companies. On the other hand, there's indirect pressure or there will be indirect pressure if the proposal becomes a law for all other listed companies to slowly and gradually start disclosing their ESG data if they want to raise funds from these or are looking at investments from this ESG mutual funds. The second kind of development is around growth of ESG linked capital markets. So just looking at some of the stats from a mutual fund perspective, ESG focused mutual funds have grown almost 4.7 times in a 2-year period from 2019 to 2021. The asset under management has now surpassed almost 12,000 crores INR for top 10 funds. Similarly, there is a growth in green bonds as well as sustainability linked borrowings by Indian corporates over the past few years. The data here suggests a 10 times increase since 2016 in funds raised by Indian firms through sustainable bonds. This trend is only going to increase as more and more banks and private and leading financial institutions embed sustainability parameters in their lending portfolio. The third kind of development is around growing climate commitments of Indian multinationals. Obviously, the government has made a pledge to be net zero by 2070, but ultimately it is going to be businesses that will have to work towards meeting these targets. Leading companies in India are already coming up with a lot of sustainability initiatives and are making their own net zero and climate friendly pledges. Here is a snapshot of some of the ESG focused goals as well as initiatives which have been undertaken or are in pipeline for companies across different industry sectors. They range from trying to reduce greenhouse gas emissions on an absolute as well as on a product perspective, trying to use less water, minimize waste, encourage use of more recycled materials in the supply chains, as well as working towards ensuring more tree plantations, as well as zero waste to landfills. these initiatives, while more and more companies, as the ESG agenda is drilled down from a medium as well as a small scale business, will have to embed them into their business operations going forward. Lastly, Indian companies, private, public, across different sectors, will be impacted in some form by ESG goals of global multinationals, particularly in instances where these Indian firms act as suppliers or as customers of these global multinationals, right? So the case is Apple has a pledge or a target of all its suppliers being carbon neutral by 2030. Unilever has a promise of all its suppliers paying a living wage to its employees by 2030. If you are a small or a medium scale enterprise or a listed company in India, which is supplying raw materials to the likes of Apple and Unilever, you will have to start considering sustainability parameters in your business operations now. Uh, there is I don't know, I'll pause here. Let me know if I'm going a bit too fast. Chirag, if there are any immediate thoughts or questions at this stage that you might want to pick up, or else, at the end of the session, we will be leaving about 15-20 minutes for Q&A, so we can pick it up there. But that's kind of a brief snapshot of what's happened on the ESG front from a global as well as an Indian perspective. Now let's look at the business case for Indian companies, right? So a lot of companies that I've spoken to in the past year or so often believe that ESG comes at the expense of profits and growth. However, that is not always the case. In most instances, companies, yes, they have to manage a fine line between over focusing on sustainability side and in turn, driving value for the shareholders and the investors. But there's a if you are able to kind of get the right balance, there's a lot of values that and opportunities for Indian companies while focusing on ESG side of things. So the multiple advantages for Indian companies, which we'll now look at in a lot more detail. The first one is superior performance. So at the start, we saw companies on the S&P kind of performing higher versus stock markets around the time of the pandemic, and that has been kind of supported by various other research that have been conducted in this by the likes of Fidelity and the global consulting firms like BCG and McKinsey. So obviously, companies which have focused on the ESG side of things have performed well versus their competitors, as well as the benchmark stock exchange index. But for private companies as well, focusing on ESG has often meant higher margins and valuations. And there's instances where ESG programs have contributed more in driving shareholder value, as suggested by research from BCG and McKinsey. Now, the global kind of research and the analysis is also true from an Indian market perspective. And recent articles and research which I've come across paint a similar perspective and a picture from an Indian market landscape. So top 50 ESG investments have outpaced the benchmark Nifty 50 index. Uh, Similarly, as a lot more Indians and investors take up to conscious investing, the Nifty ESG as well has beat the traditional Nifty 50 index in the last year, and this is in the context of the pandemic as well, where we initially saw a fall in the stock market, but which eventually stabilized, and since then it has been on the increasing trend. So the superior performance is one of the business case for Indian companies. The second one is tied to that, but particularly around the competitive advantage, in that focusing on ESG parameters can help organizations and Indian companies achieve operational efficiencies. In in addition to that, they can look at entering new markets, launching new products and services which are in line with the changing consumer and customer trends and preferences. So this is a case of a private equity company which invested in a global paper manufacturer. There's a Bain article about this, but essentially what it suggests is that that global paper manufacturer was able to achieve a 5% improvement in its EBITDA margins by focusing on ESG kind of aimed value creation as well as risk mitigation activities. That included a combination of trying to improve usage or trying to get efficiencies from usage of raw materials like resources like water, raw materials, electricity, trying to reduce greenhouse gas emissions, trying to reduce waste, trying to focus on labor productivity and health and safety instances. And overall, the output was over a 2-3 year period. That paper company saw a 5% improvement in its EBITDA margin. In terms of entering new markets and launching new products and services, the trend globally as well as in India is on the sustainable side of things. So global plant-based meat market is forecast to reach almost 15 billion in a 7-year period from 2021 to 27. In India, it is a similar story where the plant-based market is expected to grow almost fourfold to 700 million by 2025. The Indian government, as well as a lot of the customers and consumers are demanding a shift towards more sustainable means. So there's policies around motivating us to use electronic vehicles. There's the government is also strongly focusing on the waste management side of things, and so on and so forth. So companies can look at achieving value through ESG focused initiatives. Now, it can do that on a standalone basis by itself, but it can also combine with various suppliers across its end-to-end value chains to generate more value. Look at cost reduction initiatives as well. Here, I've included an example of AB InBev, which is a global beer brewing company, which has entered into partnership with a lot of suppliers on sustainability initiatives like reducing its carbon footprint, use of alternative fuels, increasing recycling content, as well as looking at reduction in energy usage. It is forecast, or AB InBev plans to achieve almost 80 million in cost savings just through these initiatives over a 5-year period. So in summary, there's a competitive advantage that Indian companies can generate through cost savings by focusing on resource efficiencies, launching new products and services to fuel growth and expansion, which in turn links to potential higher price premiums and valuation premiums if you are looking at mergers and acquisitions, or on the flip side, through minimal risk from a financial as well as a reputational perspective. The third business case for Indian companies is, in general, getting access to capital markets and potentially lowering the cost of funding as well. So there is 2 elements to this. The first one is getting access to the capital markets in the first instance. So Adani Green, a lot of you might be aware, raised 750 million through a green bond sale, the proceeds of which it wants to use to fund capex on its existing and future projects. But on the other end, there is the flip side in that another of the listed company of the same group is now facing challenges to get access to funding as well. So here, BNY Mellon, one of the global banks, cut ties with its coal project in Australia. That has been at the forefront of discussion for a lot of environmentalists and activists over the past 5 years. And from sitting in the UK, I have seen an increasing trend where a lot of global banks and financial institutions are considering reducing a reduction in financing projects in the oil and gas space, a reduction in financing projects, which eventually might contribute further to the whole climate change and global warming agenda. There is another research which suggests that almost half of the world's fossil fuel assets could become worthless by 2036 due to the net zero transition. So if you are a company with an asset in the oil and gas or the fossil fuel space, which you might want to use as a collateral in getting funding, potentially good luck with that in the next 5 years, right? But on the flip side, if you are looking at sustainability, if you are looking at green financing in some form, there's opportunity to reduce your cost of funding as well. So A, you get access to more funding, and B, that would mean that you are able to potentially reduce your cost of funding as well. There's lots of examples in the global market where companies have taken funds from a bank, from a financial institution, where the underlying terms are on the sustainability goals, either around diversity, either around reducing the water consumption or waste, and some other business and commercial parameters that might be relevant for their operations. So in that instance, what the typical way that those funds are, those loans are structured, is that if you are able to meet the targets that you've agreed at the start of the lending, your rate of interest will be lower. If you are unable to meet those targets, there's a penalty involved, and that you might have to pay a higher rate of interest at the end if those goals are not met. So in turn, in summary, through focusing on sustainability aspects, you can get more access to a larger pool of capital, and also potentially reduce your cost of funding, in turn positively impacting your bottom line, whilst funding your transition towards the sustainable agenda. The next point is around managing risks, right? Most of the stakeholders are now pressuring companies globally as well as in India to start thinking about sustainability, and therefore, proactively and on a voluntary basis, embedding these aspects into your business operations can help mitigate reputational as well as financial risks. So some of the news articles here which suggest that if you do not focus on ESG issues, you potentially risk losing your investors. If you are a public company but a negative public instance comes to light, this is a case of Boohoo, a UK-based retailer, which saw almost 1 billion wiped off its market cap, as it claims around modern slavery and very bad and poor labor conditions came to light in its supply chain. From a business perspective, depending on the industry sector, there will be additional costs that a drought or a flood or a wildfire might involve for your business, and that will mean deploying additional resources and more financial costs. So in general, proactively looking at ESG aspects of your business can help manage both reputational as well as financial risks, and disruption risks as well. The next point is attracting and retaining talent. Employees are increasingly preferring companies that demonstrate responsible behavior and a purpose. It's the case that I have experienced while I was doing my MBA. A lot of my fellow cohort members including myself, were 100% sure on some of the companies that we would definitely not work with, right? Research suggests something similar in that 72% of the global workforce will be millennials and Gen Z by the end of this decade, which in turn prefer companies which have a better purpose, a better vision, and are more aligned with the societal and the environmental aspects. So for Indian companies which want to attract and retain the best and the top quality talent of the next generation, focusing on ESG will be a big business case. Oil and gas companies globally, from my discussions in the UK as well as the US market, is on the lines that they are struggling to recruit talent as more and more kind of graduates and people on the analytics side as well as on the MBA side prefer to work for sustainability startups, prefer to work for solar companies and so on and so forth. And PwC research suggests something similar, that ESG is key to securing talent amid skills shortages. And there's a research around how UK post Brexit will need foreign talent in the ESG space if it wants to achieve its net zero pledges that the government has made. And lastly, the business case is around managing engagement with stakeholders, managing their requirements as well, including regulatory compliance. So this is around, mandatory reporting requirements that we've seen in India, which will be applicable from the next financial year. But US, Canada, UK are looking at similar mandatory disclosure legislations on the ESG front. There's the mandatory side of things, but companies are also looking at ESG disclosure on a voluntary basis, which is in some form linked to the point around competitive advantage. So there's a listed company in Mumbai that I have been in conversations with, and they are looking at voluntary disclosing ESG data, even though they are not within the current SABI mandate of being the top 10 or top 1,000 publicly listed companies. But most of their competitors and peer group report ESG data, and they are the ones which essentially are kind of, the odd one out. So for them, on disclosing ESG data on a voluntary basis is a business imperative. Similarly, there's a private pharma company that I am in discussions with, based out of India. 80% of their products or customers are in Europe, essentially in Germany and in Switzerland. And they are pressuring that organization to start thinking about sustainability in their organization, start disclosing ESG data, because in turn, these companies in Germany and Switzerland have their own sustainability goals, right? So to meet these growing stakeholder requirements around the ESG side, either starting some of the initiatives within the operations and subsequently disclosing ESG data does represent a business imperative, either on a mandatory or a voluntary basis. Tied to the point around ESG reporting, there's multiple advantages of that. It in some form linked to most of the business cases that we've discussed earlier. The first one, slight duplication, but yes, again, it is managing communication and engagement with multiple stakeholders, disclosing ESG data, and more importantly, showing improvement across some of the key parameters can lead to improved ESG ratings and enhanced branding. There's a lot of rating agencies which have come up in India, which are dedicatedly focused on the ESG side of things. But global companies like Fitch and Dow Jones Sustainability Index are also publishing their own ESG ratings, including for Indian companies. So the more data you disclose and the better improvement that you show across those parameters will potentially lead to higher and an improved ESG rating, in turn kind of enhanced brands, which potentially will also lead to an increased access to capital and the lower borrowing costs that we discussed, in turn kind of helping management of organizations generate higher value through improved stock performance, for example, higher deal and valuation premiums if you are looking at M&A, through retaining talent, so that you don't need to focus and waste your time and money in recruiting newer talent if a lot more people are looking to leave your organization for ESG because you do not have the right kind of vision, or because you're not looking at the social side of things. So that's kind of a wrap on the business case side of things, the advantages of ESG reporting. We'll now move on to discuss and get a perspective on the ESG reporting landscape, both globally and then subsequently in detail from an India perspective. So there's multiple ESG reporting frameworks that are out there, right? The more you speak with, or rather every other day, there might be a different non-profit body or a different global organization wanting to come up with its own matrix around ESG disclosure. But for ease of reference, I've tried to categorize into a few buckets. The first one is, and primarily quite a lot of them are outward looking. What that means is companies will have to disclose its impact and the implications of its operations on the environment and society. So within this bucket, the SEBI template, the SEBI requirement falls within this bucket, and so does a lot of other global standards and frameworks like Global Reporting Institute, CDP stands for Carbon Disclosure Project. On the left-hand side is the UN Sustainability Development Goals. So all these ask companies to disclose data, which essentially talks about what is their impact on the environment and society. The second bucket and category is inward looking, which is more around the fact that companies will have to disclose what is the impact of external environment on its business operations. Within this bucket sits TCFD, which is Task Force on Climate-Related Financial Disclosures. There are some sector-specific disclosure requirements. Principle for Responsible Investment, the EU SFDR, they essentially are kind of focused on the financial services sector. PRI is more on the investment side of things. So if you are a private equity company, if you are an asset manager, you might consider a principle for responsible investment as a guideline while looking at ESG disclosure. And lastly, there are a few others which maybe sit within the overall umbrella, but have a slightly different meaning around the first one is EU taxonomy. So there's a proposed legislation in the EU which categorizes different activities across different industry sectors on whether that can be considered as sustainable or not. And the last one is science-based targets. So that science-based targets is essentially a non-profit which is looking to assess and certify in some form some of the goals that companies in India or globally might have, and kind of, if they want a bit more credibility, they will approach the Science-Based Targets Institute, which in turn will review, assess, and certify that the goals that a particular company that have set up is in line with what is required from a Paris Agreement basis, which was agreed back in 2015, which essentially means that these goals will make sure that they will limit the greenhouse gas emissions or global warming to 1.5 to 2% pre-industrial levels. Now, kind of, we'll look at some of these global standards at a high level. The first one and the most well-known one is GRI, which stands for Global Reporting Initiative. It's one of the oldest ones as well, launched back in 1997. It encompasses kind of reporting requirements across environmental, social, as well as on the governance side, right? So you've got general disclosures around the operations of a company, the economic disclosures around performance and market pressure, the environmental side around, what are the materials and the resources that you consume, how much of that is through sustainable means, how much of that is through, the normal traditional means, and on the social side as well, disclosing data around health and safety, diversity, human rights, and engagement with communities. This standard is kind of suitable for companies of any size. It could be a small startup, it could be, a private company, or it could be a publicly listed global multinational across sector, across different locations. But this GRI is kind of all comprehensive and caters to the environmental, social, and the governance side on a comprehensive basis. The next one is CDP, formerly known as Carbon Disclosure Project, now just known as CDP in its short form. This is more focused on the environmental and the governance side of things. So it asks companies to disclose a kind of its policies and frameworks in place to mitigate impact from a climate change perspective. And in terms of disclosing data on the environmental parameters, it looks at greenhouse gas emissions, usage of energy, the water usage, as well as efficiency, and its impact on forests and on the agricultural side of things, including biodiversity and potential risks and opportunities. So this is slightly different compared to GRI and has the environmental and the governance side as its key focus. The next one is TCFD, which which is around the inward-looking framework, in the sense that companies have to disclose what does climate change mean for their business operations. Again, this is focused predominantly on the environmental side and the governance side. And companies have to disclose, if they were to follow this standard, what is their policy and the governance framework around climate-related risks. What are the strategies that they have put in place within their organization to mitigate some of the challenges that climate change might have on their operations? What are the risk management policies and operations in place to kind of manage and reduce the downside of potential climate risks? And lastly, disclosing some of the metrics and targets. So one of the points here, for example, is what is the financial impact on your organization if, let's say, global warming was 2 degrees above pre-industrial levels? What is the financial impact on your organization if the global warming or if the temperatures rise to 4 degrees above pre-industrial levels? So I'd suggest obviously this is a very tricky exercise, and not every company have the resources or the data or the abilities to do that. But I know for a fact that Unilever has disclosed some of the data using TCFD. So if you are looking for an example, it might be worth you looking at the annual report and disclosure from Unilever. The next one is SASB in its shortest form, or Value Reporting Foundation, which is a US focused initiative, but that again kind of combines disclosing data across the environmental, social, and the governance spectrum. Last year, in mid 2021, VRF, which stands for Value Reporting Foundation, and SASB merged to come up with a consolidated set of reporting framework. So SASB, or Value Reporting Foundation, lists out some of the key data points across the ESG parameters that you can disclose across 72 industry sectors. So depending on the industry that you are operating in, SASB has some prescribed parameters which you can consider if you are looking at disclosing ESG data within that relevant industry sector. The next one is UN Sustainable Development Goals, essentially kind of rolled out by the UN, encompassing kind of the environmental side, the social side, the governance, as well as the economic side of the society. There are 17 different UN sustainable goals across which cater to different elements. For example, goal number 12 is responsible production and consumption, which in some form embeds kind of the circular economy principle. There's climate action, there is life on land, there is life on water, and the last one, just like from an international tax perspective, where you've got a multilateral instrument rather. So the last one kind of talks about global cooperation to make sure that governments as well as organizations alike are working together to eventually meet all of these targets that the UN has set in terms of sustainable development goals. The latest and the newest one is ISSB, which was kind of announced by the IFRS Institute during the COP26 Summit in November last year. It stands for International Sustainable Standards Board, and is aimed at bringing kind of sustainable reporting on an equivalent level as financial reporting. So, if you do not, it's becoming a bigger business imperative for everyone to embed ESG parameters, sustainability parameters into the decision-making process. And ISSB is aimed to force this disclosure becoming just as relevant as looking at a balance sheet or your profit and loss account or a cash flow statement. The other intention is to drive a global, consistent, comparable, and a reliable sustainability report using a building blocks approach. So they will set a standard, and countries like India or the US or the UK might consider some added disclosure requirements on top of what ISSB would prescribe as a standard. There is a draft and a prototype standard that they have already announced, which essentially is a combination of TCFD and SASB. We've already discussed both of these on an individual basis just a few minutes earlier. So what ISSB is prescribing as its prototype standard is a combination of TCFD, which is more around the governance, the strategy, the risk management side of things from a qualitative disclosure perspective, and including the quantitative data that is prescribed for those 77 specific industries in SASB. So at this point in time, it combines both TCFD and SASB requirements, but obviously it is a prototype standard, and we'll wait to see more guidance and kind of updated standards and guidelines from them in the near future. That was kind of looking at a global perspective. Now, obviously, for us as the accounting profession in India, more importantly, or kind of one of the most relevant ones could be the SEBI Business Responsibility and Sustainability Reporting. Essentially, that template or that framework is structured as 3 key sections. The first one is around general disclosure, section A, where you need to disclose very basic information about the company around what is the size of the company, the location, the products, number of employees, and in some form CSR activities that it has been engaging in during the year. The second section is around management and processes. So have you got the right kind of processes, governance, and the leadership structure in place to make sure that you are progressing on the ESG agenda? And the last section C, is around principle-wise performance. So it is essentially divided into 2 categories: essential, which is kind of a mandatory disclosures that companies will have to look at, and leadership categories, which is more on the voluntary side. Section C is divided into 9 key principles and elements, which in turn cater to different stakeholders of a business, employees, maybe suppliers, customers, environments, and communities, and so on. So this is the broad structure of the SEBI Business Responsibility and Sustainability Report. 3 key sections: section A around general disclosure, section B around management and processes, and section C, principle-wise performance, catering to 9 key elements focused on different stakeholders of a business. Across these 9 key principles, there is a combination of qualitative as well as quantitative reporting requirements, which we'll now look at in more detail. So looking at the general disclosure, there's kind of 3 elements around it. The first one is company details. It's essentially kind of, what's the name of the company, the year in which it was incorporated, register address, and super basic information. On the products and services side, the report asks an organization to disclose top 3 products or services by turnover. And on the operational side of things, in the first section around general disclosures, companies will have to disclose location of the plants, the top 3 plants, which states are they present, basis turnover, proximity to protected reserves. So that means from a biodiversity perspective, if you've got a manufacturing or a textile plant which is next to a protected reserve where you see a lot of wildlife species, plant species, you might have to disclose that. So on the operational side, you've got, again, fairly basic information around disclosing details of where your operations are, top 3 plants by turnover, market served, top states where you sell your products in India, top countries where you sell your products from an international perspective, details around how many subsidiary or JV companies that you have, and it also links CSR information that is prescribed from a Companies Act perspective. The second section is around management and processes. The first element is for companies to confirm whether they have policies in place for each of the 9 principles that are subsequently covered in section C of the report. So this is a yes/no answer, and providing basic details around whether you have the policy in place, whether that has been approved by the board, where's the link to that policy? If there's a lot of companies in India which are now kind of directly posting links to their, let's say, sustainability policy, say their anti-corruption, anti-bribery policy directly on their website. And then you've got kind of, whether these policies are in compliance with some of the national or international codes or certificates or labeling standards, ISO, and so on and so forth. So it's a fairly kind of straightforward yes, no, and a basic responses to those key principles that are covered later on in the report. The second aspect is around governance, leadership, and oversight. Here you have to disclose details of the directors who sit within the committees of the policies for each of the 9 principles, and you then have to confirm whether the policies are being reviewed on a periodic basis. When do you actually review those policies? What is the frequency of the review? Who reviews it? Whether there's a board of directors which are part of the committee, whether you set up a separate committee to look after that particular policy or framework. And lastly, this section asks companies to disclose, what efforts have they made to identify all the stakeholders of their business operations, whether it's communities, is it the government, is it your customers or suppliers? What is the frequency at which you communicate with those stakeholders? Do you send an email out to your suppliers every 6 months, every 3 months, whether at the end of the quarter, any communication, if you are a listed company, that you roll out to public, whether that addresses or has information which might be relevant for all of the stakeholders that you've been able to identify for your business. And it also talks about what is the channel of communication with those stakeholders? Do you send out an email? Is there a newsletter? Is the disclosure out there on your website? So on and so forth. So the third element of the second section is around identifying stakeholders of the business, confirming how frequently do you communicate with them, and also including what is the channel of that communication. The third section, around principle-wise performance, as I mentioned earlier, is broken down into 9 key principles, looking at different stakeholders of the business. The first one is around the fact that businesses should conduct and govern themselves with integrity in a manner that is ethical, transparent, and accountable. Here, it talks about the number of trainings that you might have imparted to your employees, and it covers the entire workforce. So board of directors, key management personnel, other part-time employees that you might employ within your business, and workmen. So there's a different kind of sections and different kind of areas where you need to report training information for your employees, but also your workmen, which is essentially kind of, if you are in a sector like manufacturing, there's a different legislation that will be applicable to you. And so there's the definition of employees and workmen might be different. And therefore, to cover both these categories of people who might work for you, you need to disclose data across all these categories. Then there is a requirement for you to disclose any fines or penalties or punishments, monetary as well as non-monetary, that your organization might have received from a regulator, details regarding any of the appeals or revisions that you might have made against those fines or penalties, and around kind of disclosing the number of complaints, bribery cases or corruption cases that your business would have received during that particular financial year. Lastly, from a transparency perspective, it also asks details of interest within an organization or companies that you might work with, involving members of the board. So this is more to ensure that there's transparency and accountability within your operations. So that's the first principle, looking more around transparency, accountability, and on the ethics side for your business in general. The second principle is focused on your goods and services, and essentially kind of ensuring that they are produced in a safe and a sustainable manner. So here, companies need to disclose initiatives that they might have undertaken from an environmental perspective as well as from a social perspective. So there is a concept of LCA stands for life cycle analysis, which essentially kind of considers what is the carbon impact of your product across the end-to-end life cycle. So you might have raw materials which are sourced from another country, and a third-party supplier might be sending them to you in your own premises. You might engage in manufacturing and production processes, and the products might ultimately be sold to the consumers. But it asks you to assess the carbon footprint of that product or the service across the end-to-end life cycle, right from the initial stage of raw material until maybe it's a phone and it's thrown off in a landfill, right? So has your company in some form conducted life cycle analysis for your top 3 products? Excuse the typo there. Then companies need to disclose what are the measures that they might have undertaken to reduce adverse environmental as well as social impact. There is a requirement for you to disclose how much have you spent in that particular financial year on R&D as well as capex in technologies which might improve the environmental and the social aspects of your business. Then there is some of the other parameters include what is the percentage of raw materials that you have sourced from suppliers, whether you have a policy in place around sustainable sourcing, what is the proportion of materials that you have sourced sustainably, and then do you have a process in place to ensure that you are safely collecting or reusing or recycling, or if that's not the case, disposing any after sale or at the end of your life products around plastics, electronic waste, and any other waste that might be applicable for your industry sector. The third principle is focused on employees, their well-being across your value chain. So this section asks you to provide details around what is the proportion of your employees that have access to health insurance, accident insurance, maternity as well as paternity benefits, and daycares. You have to provide a breakdown and quantitative data for each of the categories of people that will work for you. So full-time employees, differently abled employees, part-time employees, and a similar breakdown for workmen as well, if that is applicable in your for your business. There is details around statutory dues, so whether you've deducted and paid provident fund at the right time, whether you have a policy in place to address receive in the first instance and subsequently address any grievances from employees, whether you have any complaints that you've received during the year, how many complaints have you received, how many complaints have you resolved, have you looked at your plants and operations for child labor, health and safety, and sexual harassment. Then you need data to be disclosed around minimum wages, any health and safety incidents, as well as trainings that you might have given to your employees around child labor, around human rights, and in general, any measures that you might have undertaken to ensure that your workplace is safe and healthy for all your employees. The fourth the fourth principle is aimed around kind of in all your stakeholders in general. So in some form, there is a duplication to what's asked for in section B. But this kind of section of the report looks at identifying key stakeholder groups for your organization, frequency of the communication, channels of communication, but more importantly, the ESG element is whether in that communication, it doesn't matter if you speak with them on a monthly basis or a quarterly basis or an annual basis, but in that communication, have you addressed ESG issues that might be relevant for each of the stakeholders? The next section is around respecting and promoting human rights. So some similar kind of data points to be disclosed around trainings, but it's more targeted towards human rights, in that, have you given training on human rights to each of your employee category? Is there a specific and a dedicated contact within your organization for any human rights issues that might come up? Have you got internal mechanism in place for addressing human rights issues? Details of any grievances that you might have received from any stakeholders around human rights? And this is a yes/no response, but do human rights assessment form part of your business agreement? So if you are, I don't know, a manufacturing company, but are looking at raw materials being supplied by third parties, whether that contract with third party suppliers covers human rights clauses or not. So this principle 5 focuses on human rights. Principle 6 focuses on environment. So here you need to disclose strategies and initiatives, if any, for addressing impact from environmental issues like climate change, pandemic, natural disasters like floods or droughts, providing details of projects that you might have undertaken around low carbon. There's a yes/no question around whether your waste or emissions exceed regulatory limits. You need to disclose your company's responses to material environmental risks like land use, emissions, water, energy, and biodiversity. You need to disclose greenhouse gas emission details for top 3 plants that might be relevant for your business. And in general, you need to disclose quantitative data around waste, energy, and water consumption, and what proportion of that comprises sustainable initiatives. So if you've used consumed electricity, say 100 kilowatt during the financial year, you also need to disclose what percentage of that electricity comes from renewable sources. Similarly for water and for the waste as well. Principle 7 is around the public and the regulatory policy side of things, and more around disclosing any details of the associations that your organization might be a member of. Are you part of, for example, CII or some of the other let's say lobbying or regulatory or business groups that might be applicable and relevant for your business? And tied to that is you need to disclose any adverse judicial or regulatory orders for anti-competitive behavior or conduct during the financial year. So this is more catered towards ensuring that you are engaging in fair business practices, because obviously in the West we have seen a lot of examples around industry bodies lobbying to change some regulations, or on the other end, not forcing governments to stop changing those regulations. So the tech lobby in the US, in the Silicon Valley, is quite a powerful lobbying group. Similarly, the National Rifle Association in the US, from a gun rights and ownership perspective, is also a very active group trying to force governments to not, let's say, put in more checks around ownership of guns in the US. Principle 8 is around promoting inclusive growth and development. This is more social focused. This is more community focused. So you need to disclose details of any social impact assessment that you might have undertaken, any CSR projects, or any rehabilitation or restoration that you might have undertaken or are undertaking in the communities. Benefits from intellectual property that you might derive from traditional knowledge, and disclose list of any adverse orders or case details of IP rights which might involve traditional knowledge. So Principle 8 focuses on the community, on the social side of things. Example being, if you are a mining company and you've got a new license, but for starting your operations, you might need to move some of the indigenous people from location A to location B. So in that instance, you might engage in rehabilitation and restoration of their living environment. And this is what you need to disclose under Principle 8. And Principle 9 is focused on the consumer side, more around have you got a mechanism in place to address consumer complaints, percentage of products that might carry kind of environmental as well as social information. ESG transparency is becoming a very big kind of initiative here in the Western world. Just reading an article yesterday, which about a supermarket chain in Norway, which started disclosing environmental as well as social information on the products in its shelves in the market, and it saw a reduction in people buying red meat and products which involved a negative impact on the environment. Right. So how many products that your company supplies carries environmental as well as social information, and in general kind of number of complaints that you might have received from the customers during the financial year, and how many of those complaints have you managed to resolve during that year. So that in a nutshell, in a slightly detailed format, is a discussion around the SEBI's reporting requirement for those top 1,000 companies in the next financial year. In summary, these are some of the key ESG metrics that you can consider, either from a reporting perspective or from an advisory perspective as well, if you are in discussions with a company around where to start or accelerate their sustainability and the ESG journey. Right. So from an environmental perspective, obviously greenhouse gas emissions, CO2 and methane, maybe raw materials usage, energy, water consumption, waste management, and procurement around, how many raw materials have you sourced sustainability as well as responsibly. From a social side, it is around kind of employee diversity, trainings, health and safety incidents, grievances, and human rights. And from a governance perspective, it is around kind of accountability, ethics, governance, both qualitative as well as quantitative, in terms of complaints that you might have received, complaints that you might have addressed, discussions around leadership initiatives, either a new technology, either investing in R&D, and in some form also linking it to CSR. The whole ESG agenda goes much more beyond the focus on CSR, right? So be careful not to blend and merge. Yes, they are related, but CSR is just around, okay, you've made profits and you provided to good causes. ESG and the sustainability agenda is ensuring that you are progressing and taking efforts to have a positive impact on the environment, on the societies, and on the communities that you operate in. So what does this all mean from an audit and from an accounting profession perspective, right? Obviously, this will mean disclosure of ESG data in financial statements. So there is scope for us to get familiar with the framework and the standard that the company is using, and in turn sign off and certify that the data that the company has disclosed makes sense, is appropriate, is correct, and presents the correct picture and an improvement from an ESG side. For that, we will need to understand and get familiar with the ESG, the multitude of ESG frameworks and standards that are out there in the market. There will be need for us to understand kind of calculation methodology for some of the ESG matrix. So, employee diversity data is easy. You get your HR data extract and male, female, disabled versus normal workforce. Some of those parameters are fairly easy for us to compute and help companies in disclosing it. But the challenges lie around greenhouse gas emissions, right? There's different levels and parameters to consider, whether it's a scope 1 emission, whether it's a scope 2 emission, whether it's a scope 3 emission. If you're looking at a particular fuel usage, what is the emissions factor that you'll have to consider for that particular fuel usage, and so on and so forth. So while we have, we might be engaged to certify or, help a company disclose ESG data, it will be important for us to be familiar with the applicable calculation methodology particularly for parameters like greenhouse gas emissions. And lastly, but most importantly, I think we as the accounting profession, outside of the disclosure, outside of the certification, have I think a very important role to play in working with companies, collaborating with them, to kind of engage in value creation as well as risk mitigation journey for those organizations and our clients through uh, helping them embed ESG parameters and metrics into their business decision-making process. This is some of the themes which I've kind of I've outlined, and this is following a lot of conversations which I've had with corporations in India, but also globally in the UK, in the US, and in some countries around Europe. Uh, so yes, ESG reporting is becoming relevant and important, but companies don't know or are struggling to manage their requirements. And some of the challenges are, you've got data in large Excel spreadsheets. It might be difficult to comprehend and consolidate and compute some of the metrics that are required. Some of the teams within the organizations have limited knowledge about applicable ESG frameworks, and which is where I think we as accounting professions have a big role to play. And lastly, there is often a lack of access to instant ESG data. So, if you are a CFO of a company attending a global kind of conference, and suddenly one of your investor comes and asks you, okay, so what's the progress that you've made in the previous quarter on the water or the energy usage? Often you don't have access to that information straight away, and that kind of leads to a lot of challenges for organizations, and it is still at a nascent stage, but organizations are still approaching it on a manual basis, which compared to use of technology, which compared to the automation side of things involves at least twice the costs, and potentially also involves 20 times more time to decipher and make sense of the data. With that in mind, kind of what's next for the ESG agenda? Obviously, as we've discussed, the scope for reporting is definitely going to expand, either both from a public as well as a private company perspective, where private equity investors as well as venture capitalists will force smaller organizations as well as private companies to disclose their data. Sustainability focused finance is only going to increase. More and more organizations in India and globally are likely to access sustainability loans, will issue green bonds. But on the flip side, the lenders, the big banks, the big financial institutions will also increasingly embed ESG parameters in their lending portfolio. There will be a convergence of ESG frameworks, and ISSB has been set up with that perspective. There's quite a lot of different frameworks out there, and slowly and gradually, hopefully, we'll see kind of a standard framework which companies can apply across the world, irrespective of the industry sector that they might operate in. And lastly, there will be a lot of use of technology that companies will resort to in order to meet their sustainability and wider ESG goals. That could be using softwares to automate the ESG reporting requirements, but more importantly around supply chain transparency. So there's conversations around use of blockchain to make sure each of the raw materials that companies might use, there's knowledge around where that particular raw material comes from. So use of blockchain and some other AI, etc., will become all the more relevant, including like smart meters and Internet of Things, where there is a need for you to maintain room temperature, say in the pharma sector, say in the logistics sector, if you are transporting medicines, if you are transporting food from location A to location B. So use of technology will only increase going forward, and more organizations will adopt them in order to meet their wider sustainability and ESG goals. So I have gone on and spoken for almost 70 odd minutes. I will pause now, drink a glass of water, but we'll open up the floor for any Q&A and any thoughts and discussion points that you might have. Thank you, everyone, for listening. Thank you.
Right. You may initially take a, once he has a glass of water, let us have some questions for him, which are posed by the members, as well as any of us can have any questions on that.
Right. So I think thanks, Pandan, for taking us through the whole of the gamut of ESG and the way you have taken the floor, right from international to weather impact, the impact on Indian environment, top 1,000 companies, what is mandatory, the ESG focused, that the investors look for this from a very big angle. If you're compliant with ESG, yes, valuations goes up, shareholders' wealth goes up, the brand valuation goes up. At the same time, if you're not complying with it, the investors' loss, the loss in the market cap has to be kept into the mind. Obviously, the compliance framework of SEBI with the 9 key elements which we have linked completely, and dividing them into every piece has almost clarified a lot of the questions which were posted. Uh, Apart from that, yes, few of the questions which we'll take is like, one question was on the chat box was, what are the sustainable bonds which you mentioned initially in the start of your presentation?
Yeah, so those sustainable bonds, like in general, I'd say the sustainability linked or ESG linked finance is becoming quite important. So there's two instruments around that, right? One is sustainability bonds, which are essentially use of proceeds, right? In that you will raise a bond like Adani Green, say it has raised 750 million. Uh, uh, Investors will subscribe to it, but you will use the proceeds of those funds on improving your impact on the environment and society, right? So Adani Green is going to use that 750 million to fund capex of its solar renewable projects that it has ongoing and will undertake in the future. So that's one element. The second is sustainability linked loans, right? So say if you are an organization and in needs of 100 million, you will approach a bank, and as part of that lending, you will agree some of the parameters in that over the duration of the loan, I will reduce my water consumption by 30%. I will reduce my waste by 20%. I will increase my diversity on the board and within my workforce to 70-30. I am right now maybe at 80-20. So there's two elements of the whole funding sustainable finance side of things: use of proceeds, where you agree where you will use those funds, and so that's essentially on the bond side. And on the loan side, it is more around you will as the sustainability loans is linked loans is more around kind of you agreeing targets, and if you achieve those targets, as I mentioned, there's a lower rate of interest, but if you do not, then as a penalty, there might be 100 basis point increase in the interest that you will pay. So that's essentially how the in at a very high level the sustainable finance works, right?
I think yeah, works good. So I heard the new term of sustainability loan as well, and there was one similar question posted about that, in the SME sector, how to go about for this sustainable loan finance or a bond finance. Is there any pre-filled procedures, or it's like any idea about how SMEs can go about this?
I mean, the thing is, it will obviously depend on. So every bank is coming up to the extent I understand. Every bank is coming up with its own kind of policies and frameworks to make sure that the next round of lending, the next portfolio that they might have, is fit for purpose from an ESG perspective. So I think it's more around kind of the organizations having proactive conversations with their banks and with the lenders or the financial institutions that they might have relationship with. But for bigger organizations or from an SME perspective, I'd say that a lot of private equity funds, a lot of venture capital funds, as well as impact investors, right, in India, are looking to give money specifically to businesses which are kind of in the sustainability space. So the impact investment sector has also grown quite a lot over the past few years. So that is one of the funding mechanism that SMEs can consider. But I think like ESG mutual funds, banks are also slowly and gradually trying to embed ESG parameters while lending to the private kind of SMEs and MSMEs sector as well.
I think one quick short question somebody has, what if I'm contributing tax or corporates are contributing so much tax? Where would it fit in that ESG model? In which of the principle would I fit that tax contribution?
So, I mean, I don't know. This is a very kind of interesting question, and I'm sure there's multiple perspectives to it. But I think, just because you pay tax doesn't mean you kind of, just tick all the boxes on the ESG side. Yes, your tax will ultimately be used by governments to, improve life for the communities and societies by building infrastructure. But on the end, you might still be tax paying, but you might be in an industry that is also contributing to greenhouse gas emissions, right? So I think different perspectives around it, but yes, I think paying the right kind of tax is the first element towards your organization starting on the ESG journey. And I'll kind of add that we discussed Global Reporting Institute, right? The Global Reporting Initiative. So one of the modules as part of within that GRI framework is around tax transparency, right? And it is also linked in some form to country by country reporting. That is a standalone tax initiative in itself. So paying the right kind of tax, but also kind of disclosing where have you paid the tax, right? Paying 10 million in Cayman Islands will only mean something if you've got 5,000 employees in Ireland, right? And where you've barely paid any tax. So there's multiple aspects just from a tax perspective as well that organizations will have to consider. But yes, tax transparency is one of the starting points, I'd say, from the ESG side of things, more on the governance side, right? Because have you paid the right tax or not? And in the UK, I'll say that there is a mandatory requirement for organizations above a certain threshold that companies have to disclose what is their tax policy on their website, right? So in some form, I think that trend, those kind of initiatives around transparency will eventually kind of come to India as well. But for big organizations which are within the remit of country by country reporting, I think this is a standard kind of element for them to look at.
Good. And I think multiple questions around certain things, but I'll just combine into one is where to look for such data, any website, any books, or is there any tailor-made software? I just fit in the few parameters which you've talked about company's detail, and I get my ESG report ready. And is that ESG report to be certified by chartered accountants? So most of the questions are around this.
I mean, it will depend, right? And I'm sure people from an audit perspective can also contribute. But I mean, at the end of the day, companies come to us, and our certification means something. It's a stamp of validity. It's a stamp of assurance that the data is right. It makes sense. So it's something on those lines. For those top listed companies, BRSR will form a part of their annual report. So it has to be certified by CAs, and company directors will have to own responsibility for that. But for private companies, I don't think there is any mandatory requirement as such. But as I said, validation from an accountant would mean would provide a proof of assurance, would provide kind of a lot more kind of let's say from a quality perspective that someone's verified it, someone's checked it, because the whole idea of greenwashing, the more discussions around ESG, on the flip side, there is even better increasing discussion around greenwashing, right? So who's there to verify the data? Who's there to kind of confirm that what companies are disclosing is right and makes sense? So in some form, obviously we as accountants will have a bigger role to play, and slowly and gradually, as more kind of funding is linked with the ESG side of things, certification from an accountant might be a mandatory requirement. Let's say from a bank which has lent you 100 million, right, or from a financial institution. So I think it's a combination of mandatory and voluntary requirement, and will depend on the business and the commercial case for that particular organization.
And any space to look for any software, any book, any website which you recommend?
I mean, there's no standard kind of website as such, but the thing is, it depends, right? So it's more about you working with your client, with that organization, to understand what exactly are the key risks, or where does the opportunity lie. Maybe it is around water reduction, because it's a mining company and its operations are in Rajasthan, where 6 months down the line there's a forecast of a drought, right? So it will depend on what parameters are relevant, are important for the management of the organization, and slowly and gradually start from there. So if you look at the SEBI report, or the GRI kind of template as well, it prescribes some of the data points that you might look at. So for example, water. So if I look at SEBI BRSR, it talks about two things from a water perspective. What is the total amount of water that you have consumed, and what is the percentage of water that you have used which is coming from recycled sources, right? So essentially you might be drilling 1000 liters from the ground, but that only means something provided you are also engaging in efforts to recycle and reuse that water, right? Or whether you've kind of set up a rain harvesting mechanism on the roof of your factory or something. So those are some of the data. So if you look at the frameworks that are out there, GRI or SEBI BRSR, they do prescribe the matrix to look at, and the data and the sub data points that the framework demands that you disclose data from. So there's no website as such, but I'd say look at the templates of those frameworks, and you can potentially start from there. Mihir sir had a
Hello, yeah.
Yeah. No, I have a very general question, sir. Do you think that wider practice and acceptance of this ESG would bring a clear divide in the genre of industries? So do you think, as you said, that the fossil fuel industry will completely vanish? Do you think that would be the case, or probably there would be some kind of a different diversification? Or, I mean, what happens to Exxon? What happens to, the Amaron? I mean, not Amaron, but I've forgotten the Aramco, sorry, of Saudi Arabia.
So I think everyone's kind of, that's a very interesting in question, and thanks for kind of bringing that up. I think it's a case of adapting, because the output of Saudi Aramco and Exxon, it's not just to power our vehicles, right? Petrochemicals are used in preparing producing plastic, to the suit that I've worn and to the t-shirts that quite a lot of others have. So it's to completely kind of say that Saudi Aramco will not be there, I don't think is the right statement to make. But I think every energy company is now being cognizant of the fact that the future is towards renewables, right? So if you look at it, a lot of them are diverse or divesting their fossil oil and gas assets. They are more and more buying like wind farms and investing in renewable projects, and also kind of trying to reposition themselves not as oil and gas companies but energy companies. So Total is one example. It has then rebranded itself as Total Energies. Until last year, it still potentially is an oil and gas company, right? But everyone, the management is becoming cognizant of the fact that the future is shifting. It is no longer based on oil and gas, and therefore Saudi Arabia, right? If you look at it, the kingdom is now coming up with means to diversify its income. It is banking a lot on tourism. It is banking a lot on opening up the economy to a lot of other kind of the social side of things as well. So it will not completely shut off, but yes, the trend is slowly and gradually moving towards the renewable space. And even within the oil and gas side, traditional businesses, a lot of companies are now looking at using renewable and more sustainable means of production as well. So earlier maybe it was a diesel powered machinery. Now they are looking at electronic vehicles to transport the oil and gas. Now they are looking at more efficiencies from capturing methane within their premises, capturing carbon within their premises, and trying to convert that into something which they might eventually work out carbon capture and storage some on those lines. So it is kind of shifting in some form for sure. And a classic case I'd say is of Ørsted, the Danish energy company. Like, it was a traditional oil and gas company, but it preempted the shift towards renewables, and right now almost 65 or 70% of its revenue comes from renewable sources. So it might be worth, someone who's interested, who's looking into the oil and gas sector, to read the story of Ørsted. I think that's a brilliant example of how companies can preempt and proactively manage the shift towards a sustainable means of living.
Wonderful. Thank you.
I think excellent. There are a lot of more questions and other things. I definitely recommend President to keep a longer session on this, because the way the interest is and the questions are around it, and there is a lot more to be shared. So I would definitely recommend BCS to look forward for that.
Before
Yeah.
Chirag just proposes a well-deserved vote of thanks, I can just say this is just a trailer. Picture abhi baki hai, because we have just taken a baby step to understand what ESG is and how ESG will impact our profession. So thanks for giving us this opportunity to be addressing our members. And I will request now Chirag to propose a very well-deserved vote of thanks.
Surely. Just before I propose that, for the benefit of all, some forthcoming events of the society. Tomorrow, 13th of January, we have a panel discussion on nuances or interplay between anti-money laundering law, new Benami law, and Black Money Act. It's free for all to attend. From 24th Feb to 27th Feb, one of the premium programs, the 55th RRC, is there. In physical as well as virtual mode. The physical mode is already full, and the virtual mode is still open for certain participants. If you want to register, quickly go ahead. On 18th of Jan, we have another program by the managing committee, how to develop forensic accounting practice and investigations around it, by Chetan Dalal and Kanwal Mukhi. We'll be having a chat on that. That's also a free program members can take benefit of. 21st and 22nd Jan, there is a workshop on valuations by the Commercial Allied Law Committee. On 10th of Feb, the DTAA course, 22nd DTAA course starts from 10th of Feb till 20th of March with various speakers. Again, who wants to take benefit can take off all those events. With this, I would definitely like to give a formal vote of thanks to Spandan for spending his time right from the country where he is managing the timing difference as well. And thank you for taking us through the entire gamut of ESG in 70 minutes, which opens up a lot of questions, a lot of brains. And we all were wondering what is it all about. But those 9 key elements which you have summarized for SEBI is what at a first stage, would be very helpful for all our participants as well as chartered accountants in India. And I am sure that, the knowledge which you spread on ESG today would definitely cover the carbon credits we have created by, having this Zoom meeting. So, that would definitely cover the ESG for us. So thanks for sparing that valuable time and your resource. And we would be happy to have you more on our platform when we take this step forward towards this ESG. And I, on behalf of BCS and all the participants, give a very hearty vote of thanks to you. Thanks a lot.
Thank you, BCS, for the opportunity, and thank you everyone for staying this late with me in the evening. And as we've all kind of agreed, this is a very new topic. There's evolving legislation around it, and obviously I had to cover quite a lot of things. Potentially quite quickly as well. So I welcome kind of any other thoughts or discussion that any member has in this space, and can pick up the discussion offline as well. So anyone on the line, feel free to reach out to me on LinkedIn or my email. And I'll be kind of if it's for me as well, it will be a great learning opportunity to understand your perspectives, your experiences as well. So it's a two-way street. And hopefully, you've at least I've managed to create a thought around ESG in your mind, but I'll be equally willing to learn from your experience and perspectives as well. So and once again, thank you BCS and the senior leadership community for this opportunity. Thank you.
Thank you.
Thank you.
Thank you.
Thank you, Spandan.